Let's get started with the first conversation, and I'm talking about the initiative by the Reserve Bank of India to start allowing traders, investors, retail participants like yourself and me, in fact, to buy and sell bonds directly. What you need to do is you need to go to the website of the Reserve Bank of India called RBI Retail Direct.org.in, and it'll guide you through a process of registration which is actually quite self-explanatory. You will need to provide details such as your PAN card, your Aadhaar if that's what you're giving for your proof of address, and details of your bank account, several other things. And then finally, once you've done all of those things, you'll also have to submit a scan of your signature as well as a check in the bank that you want to transact with, and then you'll be taken through an eKYC process. I want to say that the process is seamless. For the most part it is, but when you reach the end of it, when you reach the eKYC process, and I'm saying this because I actually attempted to do this in the run-up to this show, there are a few niggles that I hope will get sorted out by the time you attempt to do so. Now, let's talk about this in more detail. I'm joined by my first guest today, Harshvardhan Roongta, who is the co-founder of Roongta Securities. Exciting times, Harsh. Thank you so much for joining in. Your first reactions to this is something that has been in the works for a while. It's exciting because it's a great product for investors to invest into directly, right?
Absolutely, Alex. So in fact, anything new that comes into the financial market which brings the sovereign bonds directly to the investor, I think it's a great move. Most importantly, because until now, the participation in government securities was that of only the institutions, and if a retail investor wanted to participate in it, he had to go through the mutual fund route. Now, wherein you would apply and you would invest in the mutual fund would in turn go and buy papers based on their choice. Now, what this direct option offers to the retail investors is that you can choose exactly the tenure of the bond that you want to invest into. So you will register yourself on the retail direct gilt account. And thereafter, you can choose the kind of security that you wish to invest into, the tenure that you want to invest into, and you can pick and choose for yourself. And most importantly, it's without any cost whatsoever.
Yes, I think that's important to state because all that they're going to charge you is any bank charges or transaction charges, if at all they are applicable to you. The Reserve Bank of India is providing this entire service for free, and the registration process is also free. Now, I won't go into too many details as far as the registration process is concerned because I think that is pretty self-explanatory. And by the way, there are helplines that the RBI has provided also, and there are very helpful individuals. I think, if I'm not mistaken, the Clearing Corporation of India's employees have been asked to help out with this process of registration, and they are indeed quite helpful. But Harsh, I want to talk about the underlying asset, which is the government bond, and there are two options that are being provided to retail investors. You can either buy from the primary market, which is when the government issues securities, and you can buy in the secondary market. Which, according to you, should be the first port of call for investors trying to cut their teeth in the sovereign bond market initially?
I wouldn't say there is anything specific to which option you should choose. So let's understand. I just want to take one step behind and also explain the distinct advantage of any investor putting money directly into government securities. So the first point, imagine there is a person who's just recently retired, and obviously retirees are looking at long-term solutions. I mean, if you look into a bank deposit, you may get a deposit up to 10 years in tenure. And if in case you're looking for any kind of a deposit wherein you want longer tenure, even beyond 10 years, then government securities would be one such option. So this particular individual who wishes to invest logs onto his and creates his account, logs into the account, and now he has a choice to pick between central government securities. You would also have an option to invest into the state government securities. You have treasury bills and sovereign gold bonds. So now, when you're looking to invest your money, there would be primary issuances by RBI, which is done on very regular basis. So in case you wish to apply into the primary issue and there is a process to undergo that, the yields will be known to you only after the auction is over. So once the auction gets done with, as a retail investor, you're going to give a non-competitive bid, wherein you say that whatever is the cutoff, I'm willing to take the bonds at that price. So when RBI goes through the process of auction, gets a cutoff price, at that yield is the investor going to get the bonds in his account. Now, on the contrary, when you go into the secondary market, which is the NDS, basically the negotiating dealing system, the order matching system of the Clearing Corporation of India, when you go over there and you pick and choose any bond, you will know the yields at which you're going to get them. So there is one slight difference between the primary issuance, wherein you will know only after the auction is over at what rate you have got it. Whereas in the secondary market, the rates are already there, and then you pick and choose what you want. The tenure, again, as I said, is a very important differentiating factor, wherein you can invest into even longer dated papers, and you can choose between a central government paper or a state government. So if you're choosing a state government, usually it is seen that the yields are slightly better than what you get on a central government paper. So these are the some bits of advantages that retail investors will have in this case. Being government securities, whether state or central, I mean, you're going to be reasonably assured of the safety of your capital, which has been the concern of many investors after a lot of things that are happening even in the mutual fund space. You've seen the Franklin fiasco in that matter, though it was nothing to do with government securities and gilt funds. Nevertheless, this is one very good option with investors to invest into now.
So I was thinking about it, Harsh, this is novel certainly, but in a sense it is also familiar, right? Because if you think about it, the equity markets have the primary markets where you have IPOs, and really that is the flavor of the season right now, right? So if you compare the two, there is the IPO in which you subscribe to it, there is an issue price, that security is issued to you. If you don't get allotment, you can always buy it in the secondary market when it lists on the stock exchanges. Similarly, in this, you can have a primary issuance of a government security, of a government bond, and like you mentioned, there is a cut-off yield. If you don't get it at that moment, or you choose not to do so, you can always buy that security in the secondary market. But I do want to draw a parallel and compare rather the two instruments. If you talk about government bonds and you compare them with fixed deposits, which I think to a large extent people have been comfortable with, you have to draw a line between the two, because government bonds are actually subject to market pulls and pushes, right?
Absolutely, yes. So if you were to compare with a bank deposit, let's take the deposit of a very large nationalized bank, which is considered quasi-government in that sense. So probably an SBI fixed deposit would fit into that category. We're not talking about fixed deposits, cooperative banks and smaller banks, because we've seen banks going belly up, and in that case, the fixed deposit holders have to take a cut from their deposit. So let's compare a fixed deposit with, say, probably a State Bank of India. So an individual has a choice. If he wishes to park his money, goes to, say, State Bank of India, puts in a fixed deposit there. You can, and you know the tenure for which you're putting your money in. So you're putting your money in for, say, about a 5-year, 10-year, whatever period you're putting into. You know exactly what is the rate of interest you'll get for the entire tenure of that deposit. Now, when you come to a gilt or a government securities bond, therein, when you enter into those bonds and the yield that you buy at, now, if you hold that till maturity, you will get that yield in your hand. So there is no discussion or no differentiation in that aspect. However, the journey from today to that to maturity, which could be, say, 5 years, 10 years, or 15 years, you would see the bond prices fluctuating regularly, depending on the interest rate scenario. So in case the interest rates were to go down, you will see the bond prices going up. So you will see that your value, the net value, is up. But if you're not going to sell anything and you're going to hold it till maturity, this movement is not going to make any difference to you. So if you're going to hold up to maturity, whatever yield that you see that you're buying at right now is guaranteed to you till the end of the tenure, similar to a fixed deposit. But in case you want to exit in between, then you have to be a little careful, because if interest rates go up, you will see probably loss in capital to what you've invested. So ideally, to begin with, those people who are not comfortable with interest rate movements and do not understand how to time it, this is not a product to get into that for trading purposes. So pure investors looking for long dated papers, which otherwise banks have restrictions with, and with us backing off the central or the state government, I think this is a wonderful option that has been, introduced by RBI and the government of India.
I think you've summed it up very beautifully, Harsh. I'll just add that a simple thumb rule that I used to make sense of it if you are interested in the bond market is that price and yield, like what Harsh was just pointing out, is inversely proportional. So if you see interest rates in the system going up, you will generally see bond prices going down of all those bonds that have already been issued. All right, so that's a thumb rule to follow. But that brings me to the next question, which is if you hold till maturity, Harsh, you're essentially only earning your returns through the interest. So how does it get taxed? And if you sell, for example, and you make a profit, suppose interest rates in the system have gone down, your prices then go up, and you are able to then sell at a profit. You sell at a profit, how does that get taxed?
Okay, so as far as interest payment is concerned and the interest receipt in the hand of the investor is concerned, it is added into your income and it is taxed at the marginal rate. So whatever tax slab that you fall into, it is just like any other interest income that you earn. So you will have to pay tax on as interest income. Now, with regards to capital gains, in a fixed deposit, there is no fluctuation of the capital. So whatever you've invested, you're getting that back at the end of the tenure. Whereas in government securities, when you're entering into these bonds, you're either buying above the face value or below the face value. So that depends on the interest rate scenario. For example, if the face value is 100 and the coupon rate is 7%, for example, and the current yield is 6.3, which means that you're buying a 100 rupees face value bond for say probably 101 or 102 rupees. Just a hypothetical example. So your cost of acquisition says 102 rupees, and as a result of which you're getting a yield of 6.3%. So when you receive the interest, that is going to be taxable as income from other sources, that is interest income and taxed at marginal rate. However, on maturity, though you have invested 102 rupees into this, on maturity, you're going to get 100 rupees back because that's the face value. So you, in fact, have a capital loss of 2 rupees. So this is going to be a capital loss which you will have to account for. And in case it's the other way around, suppose a 100 rupees face value paper you have bought at 98 rupees, and on maturity, you're going to get 100 rupees. So that's going to be a capital gains to you. And short-term capital gains, long-term capital gains, as a definition for debt goes, your holding period is 3 years. If you sell before 3 years, it is short-term capital gain. And being a debt product, all the short-term capital gains is taxed again at your marginal rate. In case it is more than 3 years, then the income tax is 20% with indexation benefits.
Okay. So in a sense, I think some of our viewers will be familiar with this, Harsh, because this is essentially what happens in debt, in fixed income mutual funds as well, where you hold it beyond 3 years and any capital gains that you might get in that will be will attract capital gains tax, long-term capital gains tax, and that will be adjusted for indexation. But just so that we're clear, and now coming to the most important point, I think, starting off, would you advise that it's better for investors to look at these instruments as hold to maturity and not worry about notional shifts in the capital over the course of the duration of the bond?
Yeah, absolutely. So in fact, I would definitely encourage everybody to at least go and register and open an account. Because one, for the opening of the account, there is no cost at all. So you would most certainly have yourself registered on the platform. And as and when your need arises, you can most certainly transact. Another thing is sovereign gold bonds are also available on this platform. So that's a very, very good option. And we've seen people wanting to invest into sovereign gold bonds. This becomes a click of a button kind of an option wherein you can just simply click on this and get your sovereign gold bond subscriptions going. Now, answering your query about what should be the approach of investors, I do agree with you that initially, when you enter into it, understand why you're buying into these bonds. So one is, as I said, if there is a person who's recently retired, I think this works beautifully for people who are looking for very long-term papers. So if you know that you want to invest for 15 years or 20 years for that matter, you could possibly choose those bonds with that maturity. And you know for sure that you're investing into the government of India or state government bonds, which are very secure in nature. And you don't have to continuously keep investing. Like if you put in a fixed deposit for a 10-year, after maturity, again, you have to renew it. In this case, you know the returns that you will get for the next 15 years. And you simply hold on. The prices are going to, interest rate is going to move. The bond prices will be doing will be going up and down. For that matter, you don't have to do anything until you really book or sell at that point in time. There is no question of any market volatility affecting your return. So you don't have to worry about that. However, in case you understand interest rate movements and now would like to benefit directly out of it. So earlier, if one retail investor was putting into mutual funds, the impact was diluted because there were many government securities underlying invested into it. Now, if you understand interest rates are going to go down, if you believe that and you'd like to trade upon it, this is a direct access to doing that. But I may caution you, only people who understand the interest rate movements and would like to capture it should try and trade in it. However, this product has not been technically introduced for retail traders. For people looking for long-term debt papers and debt options secured, backed by the central or state government, I think that is what you should be looking at. Parking your money for long-term is the unique advantage that this platform will offer.
Absolutely. In fact, some more details, Harsh, coming out. I think, if I'm not mistaken, they should also be flashing on the screen in terms of the minimum and maximum amount that an investor, a retail investor, can put into these securities. And I think we'll need to clarify whether it means in the primary market or in the secondary market. But the latest update that has come in is that the minimum amount a retail investor can invest is 10,000 rupees per security, and the maximum amount that a retail investor can invest in a security is 2 crore rupees. Gifting of securities is also possible. There will be no transaction charges, as was mentioned, other than the payment gateway charges in internet banking. And Clearing Corporation, as I said, is managing the process of a retail direct scheme. And finally, there could also be an app, and further streamlining of the process is possible. But Harsh, initial reactions today. Thank you so much for joining in and explaining the process, or rather the approach one should have if you are considering investing directly into government bonds, as will soon be available and possible through the RBI's mechanism. Thank you so much for taking the time.
My pleasure.